Hi, good morning, everyone. Thanks for joining us for this week's morning call. We have quite a few stock counter updates as well as our usual technical analysis, and followed by the Singapore Banking Monthly as well as the FAANGM Monthly, and ending off with our usual Singapore Weekly. So without further ado, I'll hand it off to Ambridge to start off with PayPal.
Thank you, Glenn, and good morning, everyone. So I will cover PayPal's third quarter earnings results. We had released the report last week with the title Cost Savings Progressing Well. So for PayPal, it is basically a fintech company. It helps users to transfer money from one user to another PayPal user, as well as you can make payment to merchants if you have bought any items or any products online or in store. So overall, the results, they were in line with expectations. Its 9 months 2022 revenue and PATMI came at 71% and 67% of our full year 2022 forecasts. In the third quarter, total revenue, it grew by 11% year on year to 6.8 billion. It was in line with the company's guidance. Meanwhile, PATMI, it grew by 22% year on year, mainly due to cost controls and higher net gains on strategic investments. Moving on to the positives. First of all, PayPal, it is focusing on increasing its user engagement. So the number of per active account transactions, they grew by about 13% year on year to a new high of about 50 times. So this is important because as the company, it is focusing on user engagement. It need not need to spend on advertising to attract new users. And also the company, it added 2.9 million net new active accounts in the third quarter, and which brought its total user base to 432 million. Secondly, cost saving initiatives, it helped PayPal to boost its profitability. In the third quarter, its expenses, they grew by about 11.5% year on year. However, they fell by 5% sequentially. And this was mainly because of cost-cutting initiatives that were initiated in the third quarter. The company said that it plans to cut costs by about 900 million in 900 million in the second half of 2022, and further by 1.3 billion in FY23. And this is expected to boost its operating margin from about like 21.8% in the fourth quarter of last year to 22.5% in the fourth quarter. And lastly, the third positive would be that the company, it highlighted that it's working on several strategic initiatives with Apple and Amazon. With Apple, it plans to leverage its tap to pay on iPhone technology, where the merchants in store, they can accept payments via contactless debit or credit card payments just by using an iPhone and a PayPal application. Apple Pay, it is also expected to be added as a payment option on PayPal's checkout flows. In addition to this, Amazon has also agreed to accept Venmo payments on its platform. And these initiatives, they are expected to increase transaction revenues for PayPal. So moving on to the negative, we highlight that there has been a decelerating growth in total payment volume. In the third quarter, its total payment volume, they grew by 9% year on year to $337 billion US. In comparison to the previous year's third quarter 2021 growth rate of about 26%. The growth rate, it is further expected to slow down in the fourth quarter to about 8.5%. And the slowdown would mainly be because of the weak e-commerce trends and the consumers that have lowered their spending on discretionary items due to the macro headwinds. Moving on to the outlook. Next slide, please. The company management said that it expects to report a revenue growth of about 7% to $7.4 billion US. And this is mainly because the company said that it has witnessed early signs that the low and middle income level consumers, they are reducing their spending on discretionary items, as well as it is yet to witness any early start to the holiday season. As in October 2021, it had started in October. Meanwhile, due to the cost-cutting measures, adjusted operating margin is expected to grow to 22.5%, and it expects adjusted earnings per share to be between $1.18 to $1.20 in fourth quarter, and expects to add about 2.3 million to 4.3 million net new active accounts. Uh, for 2023, the company did not provide any revenue or earnings per share guidance. However, the management over the call, they mentioned that e-commerce trends would be under pressure in 2023. However, the company it is confident to boost its operating margin by about 100 basis point due to cost cutting measures, as well as it plans to grow its adjusted earnings per share by at least 15% year on year. In terms of valuations, we have reduced our revenue by 3% for FY22 due to the macro headwinds, while we have increased our PATMI by 8% due to lower expenses. And overall, we have our DCF-based target price is reduced to $110 from the previous $116, and it's based on a weighted average cost of capital of 7% and terminal growth rate of 4%. So that's all for PayPal. I would now like to pass on to Jonathan to cover FAANGM monthly.
Thanks, Ambrish, and good morning, everyone. So I'll be covering our monthly publication on the FAANGM stocks. So there will be Meta, Apple, Amazon, Netflix, Alphabet, and Microsoft. So in terms of their performance for October, FAANGM was relatively flat, so it was only down 0.2%. Compared to the Nasdaq, it was up 4%, and the S&P 500 level was up 8%. The main reasons for this were a drag by a couple of companies. So Meta was the main laggard, down 32%, mainly due to very weak earnings where the margins were cut in half. On the flip side, Netflix outperformed, up 24% for October, and this was mainly due to subscriber outperformance, as well as the earlier launch of its new ad-supported subscription plans. Next slide, please. In terms of some of the news for some of the companies, for Meta, they actually launched their new Quest Pro VR headset. They launched it during their Meta Connect event. These Quest Pro headsets will be priced at about $1,500 US. They are supposedly more streamlined than the original Quest headset, or rather the normal Quest headset, and are supposed to have 37% more pixels per inch. So it's supposed to give the users more clarity when wearing it. So this kind of comes. It just shows that Meta is actually continuing to pour money into its AR VR reality lab segment, which so far has been loss-making. The second big news is that it's actually been ordered by the UK Competition and Markets Authority, the CMA, to sell Jiffy, which it actually acquired in 2020 for $400 million US. So the main reason for this is that the CMA deemed the acquisition to be anti-competitive because it could limit other social media networks' access to GIFs. In terms of their earnings, Meta's third quarter earnings were mixed, with revenue in line, while earnings missed by 12% due to contracting margins. Revenue growth slowed as a result of weakening advertising spend, with earnings hurt by a 19% increase in expenses. We still maintain, we actually downgraded Meta to an accumulate rating to reflect near-term weakness. Moving on to Netflix. Netflix actually is going to launch, or has actually launched, their new ad-supported subscription plan on the 3rd of November. And it was launched in 12 countries. So this new plan is actually tagged basic with ads, and actually will begin, or has begun, at a price point of about $7 US. So this is roughly half what an average plan would be. Average plan without ads would be. The company expects this to have about 500. This plan to have about 500,000 subscribers by the end of 2022, which is quite a lot given such a short time frame. And does present quite an interesting opportunity for advertisers to reach a diverse group of younger viewers. Also, this plan is expected to be margin accretive for Netflix. Moving into streaming on an overall basis, there was a September report that showed streaming strengthened its foothold at the top of US TV usage. So it currently has about 37% market share, or up 2% month on month. Netflix came in at second place with 7.3%, trailing only Alphabet's, or rather Google's YouTube at 8%. In terms of their earnings, Netflix's earnings were above expectations, with revenue beating as well, mainly because of several factors. Obviously, the first would be more membership additions that they expected, and the second would be roughly $200 million shift in spend from the third quarter of this year to the fourth quarter of this year. Moving on to Alphabet, so Alphabet actually launched a new Pixel phone, the Pixel 7 and Pixel 7 Pro, and this was priced at $599 and $899. They also introduced the new Pixel Watch, which is the first time it's come out with a smartwatch, and this would start at $349. Comes with 3 months of free YouTube Music Premium and 6 months of free Fitbit Premium subscriptions. Alphabet also mentioned that they'd be partnering with Coinbase to accept crypto payments for its cloud services. So they'll accept digital payments like Bitcoin and Ethereum to kind of widen the optionality of payments for its cloud services. And at the same time, widen the potential for cryptocurrency adoption globally. On the flip side, Coinbase also leverage on Alphabet's cloud services to process its blockchain data and expand the reach of its crypto services. The last news for Alphabet is that they were actually fined $275 million in India and this is a total fine for 2 breaches of antitrust and anti-competitive practices. The first would be an anti-competitive practice on Android, where it basically leveraged its dominant position to kind of protect its own apps on its Android OS. And one way they did this is through revenue sharing agreements with phone manufacturers. The second is it placed a lot of restrictions on developers, so basically forcing developers to exclusively use Alphabet's own in-app payment system. So both of these points are actually very recurring throughout the world. Google has just been getting fined non-stop, whether it's in the US or in Europe or now in India, based on these antitrust breaches. In terms of their results, their third quarter results were quite poor. They missed both revenue and earnings estimates. Revenue missed mainly due to a pullback in advertising spend and some FX headwinds. Their 6% year-on-year growth was the slowest since 2013, while net margins were down 9%, mainly hurt by higher headcount costs and a $3.5 billion fluctuation in debt equity investments. So with that, I'll pass my time up to Max to cover the next few counters. Thank you.
Thanks, John. So I'll start off with Apple. Firstly, Apple has raised its subscription prices for Apple Music and Apple TV Plus, where Apple Music has increased by $1 and Apple TV Plus increased by $2 per month. And Apple has indicated that the international markets will also see proportionately similar price increases as well. Now, Apple has emphasized that the price increase is unrelated to the performance of the services segment, which has seen a slowing growth for the past 2 quarters, and that the price increase is because of the increased licensing fees for Apple Music, whereas the increase for Apple TV Plus is to reflect the wider amount of shows and movies that are available now. So in late October, Apple has also announced its fourth quarter 2022 results, which we have published our reports on. But just as an overview, revenue grew 8% year-on-year, despite the expectation of a slowing demand in smartphone and PC based on the outlook given by the semiconductors company. Services grew 5% year-on-year, and this is a deceleration from the 12% growth in the third quarter. And Apple has guided for a revenue growth in the first quarter of 2023 to be less than 8%. So in this earnings call, management has indicated that the iPhone 14 Pro, 14 Pro Max, as well as the Apple Watch Ultra continue to face supply constraints. And we view that this supply shortage as a signal that the higher-end models are selling better, and this should benefit Apple because it increased the average selling price of the products. However, we also take note that the volume growth is going to face challenges because of the potentially lower demand compared to FY22. And continued lockdowns in China are going to pose significant uncertainties on the supply chains, as evidenced by the latest lockdown in Zhengzhou. As for the increased price for the subscription for Apple Music and Apple TV Plus, although it may sound insignificant because it only increases, they only increase it by $1 and $2, it actually represents around 10% of price increase for both products. So this could potentially offset some of the FX headwinds that has been the major challenge for the services segment. Overall, we maintain our buy rating on Apple with a target price of $190. And then moving on to Amazon. Firstly, Amazon has implemented a hiring freeze in its retail division as it pauses hiring for corporate roles in its core retail business. And this is expected to continue through the end of the year. However, at that time, Amazon has also announced that it has indicated that the hiring freeze does not apply to other areas of business such as AWS or its warehousing operations. And the company continues to prepare for the holiday season by raising average starting pay for warehouse employees because it wants to ensure that they maintain enough headcounts to prepare for the upcoming busiest period. Yeah. And secondly, similar to Apple, Amazon has also announced its third quarter 22 results in October. And generally, 9 months total revenue is in line with our expectations, coming at 69% of our full year forecast. But its 9 months normalized PATMI, which is PATMI stripping out the effects of non-operating income, has missed our expectations, coming in at just 47% of our full year forecast. So during the call, management has also guided for total revenue that is below our own forecast as well as the consensus estimates. And this is because the company saw a moderating sales growth across all of its businesses towards the end of the third quarter. Yeah. So we also view that the lackluster revenue guidance as a signal that the October Prime Early Access Sales event was not as successful as what Amazon has hoped. And this could be because consumers have already made their purchases during the annual Prime Day event in July, such that they don't feel the need to make any additional purchases in October, or that they may not have enough budget to do so. Yeah, for the hiring freeze, we feel that it is not surprising given the recent hiring and layoffs that is taken by the other big tech companies. And the hiring freeze is part of Amazon's continued efforts to improve its efficiency after the over expansion that it took during the pandemic. So this hiring freeze is a way for Amazon to limit the growth in operating expenses, which will in turn benefit the overall operating margin. So overall, we maintain our neutral rating on Amazon with a target price of $108. With that, I'll hand over my time to Amrish to cover Microsoft. Thank you.
Thank you, Max. So for Microsoft, first of all, the UK regulator, it has set 1st March 2023 as the deadline for the proposed Activision Blizzard merger deal. So basically, Microsoft, it agreed to acquire the gaming giant earlier in January this year for about $69 billion. However, the UK regulator, it is conducting an in-depth phase 2 review of the deal because it thinks that it would lessen competition in gaming consoles and streaming markets. Meanwhile, the US Federal Trade Commission FTC ruling is expected to come as early as November, while Brazil's regulator, it has approved the deal without any conditions. The deal should ideally go through as it is a vertical integration, and if Activision games, they remain on multi-platform. For instance, Microsoft, it has agreed that the popular Call of Duty game would remain on Sony PlayStation platform for a couple of more years beyond its existing relationship. However, if the merger deal it breaks through, then the Microsoft would have to pay a hefty penalty of like about 2 to 3 billion to Activision as a breakup fee. Moving on to the second news, Microsoft it reportedly laid off about 1,000 employees in October across various departments, including Xbox and Azure. So we attribute the layoffs. It could be mainly due to the weak demand for PC market, slowdown in cloud business, as well as due to foreign exchange headwinds. This is in addition where in July, the company had already trimmed its 1% of its overall workforce of about 221,000 as of June 30. Microsoft also reported its first quarter results in the end of October. They were overall in line with our expectations, with revenue and PATMI coming in at 23% of our full year 2023 forecasts. Azure revenue grew by about 42%, and it is expected up to be at about 37% in the second quarter. So overall, we have a target price of 319 on Microsoft, and believe that its long-term tailwinds are intact, including the digital transformation trends. Next slide, please. So overall, to conclude, we remain overweight on FAANGM. Despite the near-term macro uncertainties, the long-term secular tailwinds for FAANGM's industries, they remain intact, mainly for cloud, cybersecurity, and streaming services. And our preferred stock picks would still be Google and Microsoft, mainly because rising demand, corporate demand for high-margin cloud services. So that's all for FAANGM. I would now like to pass on to Glenn for Singapore Banking Monthly.
Thanks, Ambrish. So for the Banking Monthly, we titled it NIM and NII Surge across the board. So just a quick recap of what happened during the third quarter for the three local banks, namely DBS, OCBC, and UOB. So the bank's net interest income, it rose 42% as the net interest margins on NIM improved by 47 basis points with stable loans growth of 6%. And the NIM improvement was mainly due to the rising interest rates, as the impact of the interest rates hikes were more fully felt. For the NIM guidance, the banks have all raised their full year 22 NIM guidance. So DBS has raised it to 1.75%, OCBC 1.8 to 1.9%, and UOB to 2%. So this is the full year 22 NIM guidance. However, the loans growth guidance has been maintained at a mid-single digit for full year 22, and this is across the board. There was one negative for the bank's results, and that was that the net fees and commissions declined, and it continued to decline to 14% year on year. And this was mainly due to lower wealth management fees, as customer activities were more subdued amid the risk-off investment sentiments globally. And this was nonetheless offset by an increase in card fees as the borders start to reopen and spending increased. So the credit costs improve across the board, and the full year 22 provision guidance for the banks have been lowered. And the CET1 ratio of 12.8 to 14.4% is still above the operating range of 12.5 to 13.5%. So for the interest rates, it continued to increase in October, and the 3-month SORA was up 44 basis points month-on-month to 2.28%, while the 3-month SIBOR was up 78 basis points month-on-month to 3.63%. And this SORA month-on-month increase was the highest on record, while the SIBOR month-on-month increase was the highest since 1998. The 3-month SORA is 83 basis points higher than its third quarter 22 average of 1.45%, and has improved by about 213 basis points year on year, while the 3-month SIBOR is 115 basis points higher than its third quarter 22 average of 2.48%, and has improved by 322 basis points year on year. Now moving on to the loans growth. For Singapore's loans growth, it rose by 4.38% year on year in September to 839 billion. And this is tracking our estimate of a mid-single digit growth for 2022 as the economies in ASEAN begin to recover from the pandemic lockdown and borders start to reopen. The business loans grew by about 4.85% year-on-year in September, however, it dipped by 0.96% for the month. The loans to the building and construction segment, which is the single largest business segment, grew 4% year-on-year to 173 billion, while the loans to the manufacturing segment, it grew 12.4% year-on-year to 28 billion. The consumer loans were up 3.6% year-on-year in September to 317 billion, and this was aided by strong loan demand in the housing segment. The housing loans, which make up about 70% of consumer lending, it grew 4.8% year-on-year to 221 billion for the month. The total deposits and balances, which captures the deposits in all currencies to non-bank customers, grew by 11.1% year-on-year in September to 1,744 billion. However, the current account and savings accounts, or CASA proportion, it dipped slightly to 21.4% of total deposits, or 374 billion, as there was a move towards fixed deposits due to the high interest rate environment. For Hong Kong's loans, the Hong Kong's domestic loans growth, it declined 1.81% year-on-year and 0.47% month-on-month in September. The year-on-year decline in loans growth for September was higher than the decline of 0.97% in August. For the preliminary SDAV for October, it dipped 2% year-on-year to 1,137 million, as the market sentiment remains subdued due to macroeconomic factors, while the VIX averaged 30 in October, and this is up from 27.3 in the previous month. And the DDAV rose 2% year-on-year to 1.05 million in September, up from 0.92 million in August. For the top 5 equity index futures turnover, it saw a rise of 14.7% year-on-year in October to 15.15 million contracts. And this was mainly due to the higher trading volumes of its MSCI Singapore Index Futures and the FTSE Taiwan Index Futures. Notably, the FTSE Taiwan Index Futures grew 11.8% month-on-month to 1.58 million, and the Nikkei 225 Index Futures dipped 22.4% month-on-month to 1.17 million. As such, we maintain overweight and remain positive on the banks. The bank dividend yields are attractive with upside surprises due to excess capital ratios. The stable economic conditions as well as rising interest rates remain tailwinds for the banking sector. And SGX is also another beneficiary of the higher interest rates. Now moving on, I will be covering CapitaLand's Investment Limited's third quarter 22 results. So their 9-month 22 revenue of 2,331 million was above our estimates, and it formed 88% of our forecast. Some key highlights are that their RE investment revenue grew 48% year-on-year, and this was driven by an occupancy recovery in their core markets, which are Singapore and India. The fee-related revenue was up 16%, and this was lifted by their PE fund management as well as lodging management, as the RevPAR recovered to 92% of pre-pandemic levels. For the positives, the first positive was that their fund management fee-related revenue was up 16% year-on-year, and it formed 15% of their revenue. The PE fees, which were up 44%, were boosted by higher transaction-related fees, which formed 47% of their PE fees, while recurring PE fees dipped slightly and fell 5% year-on-year. The CLI's listed funds posted a 7% growth in recurring fees, but a 6% dip in the transaction-related fees. For the second positive would be that their lodging management fees, it rose 48%, and this is on the recovering operating performance, as well as 7.3k new units turning operational in the 9 months 2022. And this is compared to 8.2k new units in the full year 21. The RevPAR grew 41%, as average daily rates grew 20% and the portfolio occupancy increased 10%. Recovery was seen also across all of CLI's key markets except in China, and with the strongest RevPAR recovery in Europe and in Singapore. For the third positive would be that their real estate investment business grew 48% year-on-year on the back of reopening in most of CLI's markets. The significant easing of community safe management measures since March 2022 has improved business and consumer sentiment and increased activities. The leasing activity in India has similarly picked up, with the physical occupancy at business parks improving to about 39%, and this is from less than 5% in full year 21. For the negatives, the first negative would be that the China retail is lagging recovery, and this is mainly due to China's zero COVID-19 policy. They have not fully reopened since the start of the pandemic. So while tenant sales in Singapore have recovered to about 29.4% for 9 months 22, the tenant sales in China has declined 13.3%. So similarly, the shopper traffic in China has also declined 20.8% compared to an increase of 21.5% in Singapore. Excuse me. The occupancy in Chinese malls have also dipped to 92% compared to the 97% retail occupancy for Singapore. The second negative is that the macroeconomic and geopolitical headwinds are slowing fund generation and acquisition momentum. The inflation, rising interest rates, as well as the Russia-Ukraine conflict have resulted in more circumspect behavior and higher required return for capital investors, and this is limiting the assets eligible to seed funds. For the outlook, CLI's real estate investment and their lodging management business should continue to recover on the back of further easing of travel and mobility restrictions. So after having divested about 2.4 billion year to date, CLI is on track to hit its annual divestment target of 3 billion. However, its 10% FUM growth target, it may be at risk given the current macroeconomic as well as geopolitical headwinds. We maintain our accumulate recommendation with an unchanged target price of $4.12 for CLI. However, we raised our full year 22 earnings by 8% as we increase the RE investment revenue estimates for full year 22. The pickup in travel, as well as the lifting of lockdowns in China, will be immediate catalysts for CLI. So that's all I have for CLI. I'll now hand it over to Terence.
Thanks, Glenn, and good morning, everyone. For our Phillip on the ground on SATS, SATS reported first half financial year 23 results that saw a break-even in sight and also funding clarity. So in their first half financial year 23 results, they saw continued recovery with revenue rising 41.3% on a year-on-year basis, but OPEX rose on a faster pace, which is why they still reported loss for the period. But more importantly, when we look at the key metric, which is the core PATMI, excluding the reliefs, because the government reliefs for the period was down significantly by about 63 million. So they really need to turn profitable without the government reliefs. So for the period, if you look at the chart here on your right-hand side, for the second quarter of 2023, core PATMI ex reliefs came in at 21.6 million, which is an improvement. But if we strip out the M&A expense of 15 million for the acquisition, in relation to the acquisition of Worldwide Flight Services, then you can see that they are very close, that SATS is very close to breaking even, at least from a core PATMI basis without the reliefs. Another highlight from the presentation was the funding clarity. So what they will do now is to cap the equity issue to just the rights. So the rights issue is capped at $800 million, and then the rest will be funded by internal cash flows and term loans. So you can see in this pie chart here on your right hand side, the rights issue will not exceed $800 million. We think it will be 800, and then the term loans will be capped at $700 million. The term loans will be $700 million. So our views on this new funding structure is, we believe the SATS has pivoted to taking term loans because it's likely that we can infer that the rate that they get for the term loans at about, we believe about 4% based on the rate today, plus is likely better than the placement offer because the shares really is down over 30%. So this term loan will be more attractive, and they will be able to leverage their balance sheet because they're traditionally in a net cash position. So they're able to leverage their balance sheet to reduce the dilution from all these new shares. So the lower equity issuance will naturally be a positive for the company because they don't need to issue so many new shares now. And with this new optimal equity funding structure that SATS has put out, we believe it will reduce the overhang on SATS because previously they didn't put out the funding structure, so there was a lot of confusion in terms of how they're going to do it. But now with this funding structure that they put out, we believe it will reduce the overhang. And SATS has a very strong balance sheet, so they will be able to. The near-term implication is that they will have a very high gearing, but because of its strong balance sheet and traditionally very healthy capital ratio, so we believe that they will be able to pay down their debt in the next few years. There's some background. SATS will convene the EGM by early 2023. The major shareholder Temasek, which owns about 40% of SATS, has already agreed to vote in favor and to subscribe for their pro rata rights issue. Expected closing of the whole entire deal is expected by end March 2023. So that's all for me on SATS. I'll now hand over the time to Zain.
Thanks, Terence. Good morning, everyone. Apologies for some background noise for construction. So today I'll be covering the technical analysis section. For Straits Times Index, last week we saw a bullish week coming in. So this week there's a high chance we continue the rally to test the key resistance at the 3,300 area, where the resistance is confluence of a swing high back in September this year, and also two channel resistances over here. As for the immediate support wise, it's likely to lie at the 3,090 to 3,160 area, which is confluent with a channel support, as well as the key uptrend support line, which has supported the Straits Times Index since the bottom in 2020. Actually, we fell below this key uptrend support line, the purple line over here recently, but we managed to pull back up in around a half a month's time. So for now, we're likely to see some uptrend momentum continue. Next slide. For S&P 500, last week was also a bullish week as well. It's likely that we see a continuation of rally to test the key 4,000 to 4,120 resistance area, which is confluent of this uptrend channel resistance, as well as we could possibly test the key downtrend resistance line that extended a strong resistance for S&P whole of this year, as well as the Fibonacci level resistances at the 61.8 and 78.6% levels at 4,006 and 4,146. As for immediate support, it's likely to be at 3,800 to 3,900 area, which is confluent of the uptrend channel support, and the Fibonacci level supports at 3,810 and 3,908, which is the 38.2 and 50% supports. We also see there's a previous swing high at the end of October over there, which we overcame these past 2 trading days, which also adds to the case for the support being at the area. Next slide. For individual stock, we have Tesla. So for this, it's a technical sell at $197.08. Take profit can be set at $154.65. The stop loss can be placed at $223.80. The stock last closed at $195.97 on Friday. For Tesla, there's a potential breakdown of this key uptrend support line that has been holding the stock since 2021, last year, to retest the previous resistance zone, now turn support at $154 to $168. So the price broke down the recent consolidation area at $202 to $216. And also this key uptrend support line, which has supported the price all the way back then. So this is actually a bearish signal. The MACD technical indicator also currently displays decreasing momentum and also made a bearish crossover. When you look at Bollinger Bands as well, it's also expanding after a period of low volatility contraction, which gives us a signal there should be increased volatility coming for Tesla and possible downside momentum to follow through. Lastly, looking from an Elliott wave perspective, the stock is currently on a 5-wave downtrend formation and could be on the 5th wave down. Thus, with the Elliott wave calculation, the projected wave high target would be at $154.65. And this downside target is also confirmed with a previous horizontal resistance level, now turned support, which acted as a strong resistance back in September to November 2020. So that's all for me for the technical analysis section. I'll pass on my time to Paul to talk about PropNex results.
Yeah, thanks. For PropNex, I mean, as the title suggests, we think growth will return in 2023, after volumes collapse, property volumes collapse in 2022 this year. Next slide. So for the results was a huge beat. So obviously the results for the first 9 months was almost our full year results. Embarrassingly, it was almost, so obviously we got it very wrong when we forecasted. We were a bit too bearish on our forecast. So what we underestimated for PropNex was the huge market share gains they enjoyed, especially in resale and also because when property price, the selling price increased, the commissions also will rise. So that's something that also helped stem the decline volumes, and also they secured a huge jump in the number of agents, which I will discuss later. So the big segment that bucked the trend for us. So just as a refresh, for PropNex, the real estate agent, most of the revenue actually comes from new launches, but the rest will come, maybe half. Then the rest comes from will come from private resale, HDB resale. So if you look at the positive, so what bucked the trend was the resale. So if you look at the table on the left, resale revenue actually rose 11%. So even though as the industry as a whole in the third quarter, the volumes were down almost 30%, but they managed to actually generate revenue, which is a big surprise. So some of the reasons was because they was market share gains, and one of the reasons was that they actually focused a lot on their marketing efforts to push for resale. So they knew that the new launches was going to be weak, so a lot of their marketing efforts, all the marketing activities, was all focused on that. And also, of course, there was a growth in the sales source, which we will discuss later. The negative was that the new launch, as expected, was down. As a revenue, as you can see at the table on the left, it was down 12%. And as a whole, as an industry, volumes were actually down. New units transacted was actually down almost 40% year on year. So in terms of the outlook, after two cooling measures and higher interest rates, we do expect some softening in buyer interest, but I think it comes from very euphoric levels. So what we think is that we still think that the key drivers supporting selling price and demand is still intact. The typical reasons, you are like rising residential population, the healthy and low unemployment rates. A new household formations is another one. I mean, surprisingly, there were like 25,000 marriages. So this will also support the underlying demand. First, most of it should be on BTO. And then rising land and construction costs. So even if you go for 5-bedder, if you are lucky to get it, it's going to cost almost 600,000. So the whole cost structure has also moved up, and this will, of course, make the differential for private residential narrow, and also the cost of bidding for land, the construction cost has all gone up. So all this will be supportive of selling price, attractive grants, and the other main one is also the low inventory levels. So right now, in terms of inventory on hand, unsold inventory on hand for the developers is about 1.5 years compared to 3 years the average. So there's still very little inventory. We'll discuss why the developers are not bidding. And the other thing is the swing factor for us will be foreign buyers. So whether we get a really good year, it depends on how much foreign demand coming in. We've already seen some of it now. So for us, I think we'll discuss this. So one of the reasons why we think next year will be better is that this year, the number of new launches was about 4,000. Next year, the expected there's in the pipeline is almost 11,000. So this will, because there was just not enough inventory for them to sell this year. So next year, huge inventory will be supportive for project marketing, and this should give them a boost in revenue next year. So we upgrade from $174 to $2. So some of the reasons is this stock is paying around 6% dividend yield. The ROE is around 40% with a net cash. Next slide. So just to give you some flavor, there was a one-off there, but I won't bore you the details. But basically, they had to make an impairment because one of the developers didn't pay commission. But it wasn't because they couldn't pay, but it's a very technical thing because some of the funds was actually every developer only has 5% of budget for marketing, I think, and including a show flat. So once that exceeded, the developer technically cannot pay any commissions until the TOP, because government regulations, so that all the funds collected for buyers like us don't get used to go and buy a show flat, go into pay commissions first. All the money has to be used to construct the units, and then you cannot pay commissions until completion once you exceed the 5%. And in terms of why the inventory levels are so low, because developers are still very cautious. That's why you see some M blocks didn't get through. So for the recovery, what needs to happen is that if the take-up rates, if the sell-through rates for new launches this year has been healthy, then maybe second half 23, you will see developers coming into a bit more aggressively. So right now, they're still a bit more cautious. So that's why inventory has been quite tight. Okay, the other point they mentioned was this time round, despite cooling measures, the property price didn't correct, because unlike 2013 was also because there are fewer speculators this time around in the market. Foreign demand has improved from 9 to 10 to 13% in the core central region. The other thing, one of the reasons why they grab market share is because their sales force has rose about 12% to 12,000. So they increased their sales force by 1,002. So if you combine the three competitors, which is, I mean, there's only 3 competitors. There's only like 4 guys competing in this market. There's like the Huttons, ERA, and so what's an Orange, Orange, and so these 3 only had about 1,000 agents compared to the 1,002 they secured. So they continue to garner share. Of course, you can talk about productivity and agents. Of course, they did some independent. It's in the slides, but one of the things they did, of course, this is we can't check. This is some of the studies done also says that their agents are more productive, but the one we didn't include here because this one is some study by another party. We got no details. So the dividend policy remains 70-80%. Next slide. So for Singtel's results, the one that did well was technically Bati. So Bati did well because of the earnings, and also because they managed to sell the stake in Bati, so they managed to give a 5 cents dividend yield. So that's the reason for the title. Next slide. So for the results was, I think it's within expectations of for about close to 50%. There was a 5 cents special dividend. Do note that the dividends will only be paid, you can see from the table on the left at the very bottom, in 2 tranches of December and August. So some of the positive on the results of Singapore consumer did very well. So the mobile grew by 12%, 13%, which is a huge growth number. I mean, mobile is a very mature industry. It's more like a 3-4% growth, if any. So this one was mainly because of the whole return of roaming revenue. And also roaming revenue penetration has improved. So roaming revenue, just as a reminder, is a pure profit business, because when the traveler comes into the country, or a Singtel customer goes to maybe Malaysia, the arrangement is just pure profit because the networks, everything is all there. And okay, so the other thing is that of course the turnaround in Bati. So you look on the table on the left, you can see that Bati earnings jumped from 49 million in the first half 22 to 172. So it's more than a 3-fold jump. The main reason is because of prices. So prices jumped, the ARPU jumped by 24%. Although ARPU is still very small, in Sing dollar terms, only $3.20, but you're talking about a few hundred million customers. So the other reason is also in India, because of competition has been a bit more conducive. So the number of subscribers also rose. So in India, the number of competitors is now like 2.5. So there's Bati, Reliance, and Vodafone. But Vodafone has balance sheet issues. So competition has shrunk tremendously. So that's why you have this nice ramp in earnings and prices. The negative is, so there are a few negatives. Firstly is NCS. So NCS is IT services, is on the left. So this is one of the areas that they are trying to groom for the next driver of growth. But because they're going regional, they bought something in Australia, so they have to take on a lot of expenses. And some of these are, I guess, in a way also one-off for staff retention and earnouts. The digital bank by Singtel and Grab has been launched. They registered a loss. Of course, 27 million is still a lot. It's about almost 50 million their portion. So if you if you combine both, probably you're talking about 50 million loss for the whole entity. So but they actually guided that the break even could come in 2025. One of the reasons is that they are changing strategy for maybe to be a digital bank to everyone. They know they can't compete with, I guess, the banks here, the local banks. So they're going to provide selected services. So what they're going to do is the number one priority is probably loans for mobile devices. That's number one. And then some niche small and medium customer loans. The advantage for them is that they just can tap on the customer base of Grab and Singtel. So you're probably going to see this GXS app or this GSS application embedded into either Singtel app or probably in the Grab app. And so it lowers their customer acquisition cost because they can tap on these customers on paper. Whether people actually join is a different thing, but at least on paper. The other thing is, of course, Optus. As we know, there was a cyber attack. So there were two types of provisioning done by Optus. Firstly is they impaired the whole Optus investment. So this is a goodwill. There's no cash involved, no, just a paper. It's just some DCF. So they think maybe right now they can't earn so much. So this is more like an accounting adjustment. They also made another 140 million provision for any cyber attack. But do know that it doesn't take into account any class action. So, class action, the customers might combine, maybe some lawyer tells them maybe we can try and extract more money from Optus. So far there hasn't been anything now, and also there could be penalties pending investigations. But for us, we don't, even though if there is such a class action, it may not actually hit, because all this will just be recorded as a one-off, and it may not actually kind of derate the stock. Yeah. Because all this, the whole market will just consider this as a one-off. Next slide. Okay, so in terms of the outlook, I'll just quickly run through. For the outlook, Singapore consumers should still do well because of the roaming. Roaming is only back to 60% of the pre-pandemic. So you got at least another another 4 or even 5 quarters of roaming, especially if China reopens. Then for Optus, they did get a bit of customer churn. So the biggest worry is always, because of this, the customers might say, I don't feel secure with Optus and leave. So there was a bit of that. The enterprise customers didn't leave, which is the corporate customer. But the customers did leave some of it. Also in part because they didn't do much marketing, because you can't be doing a marketing program when you just had such a huge cyber attack. So they actually froze all marketing activities and customer retention. So I mean, so far we don't think there's going to be a long-term impact. That doesn't seem so far based on the number of subscribers. So the other major growth driver for Singtel in the medium term is going to be enterprise. So in the near term there won't be much because of the legacy system, but the big growth for them will come from data centers. So once the Tuas and Thailand data centers turn on in 2025, you're going to see a big jump in earnings or EBITDA from enterprise. But you got to wait. I mean, it's going to be only 2025 because these are new data centers. So obviously, it's like you have a new building, you have new rent and new customers. So the earnings will spike up from that, but you have to wait until 2025. Then for NCS, so this is the other area they want to grow. So Singtel. So in general, telecom business is mature. So they're trying to pivot towards IT services such as NCS. So they have plans to grow into a Asia Pac provider. NCS was in the past, like historically based in Singapore, mainly catering to the government and government agencies. So now they're just trying to go overseas, but you have to pay for it. You want to make acquisitions. You want to ramp up your staff in India and Vietnam for lower costs. Employees, right? Because IT services, it's all about getting the ideal cost structure. So you have to go to India and Vietnam. So that one will take time and it will be costly in the beginning. So the other main driver will be Bharti, which I think we highlighted earlier. So in a nutshell, in terms of outlook, the two areas of growth is only going to be Singapore consumer and associates. So the rest are going to be quite subdued. So we still maintain an accumulate and unchanged target price. You will notice that of the $3, 1/3 of it comes from actually Singapore and Australia. So the bulk of the Singtel sum of parts, which the bulk of the valuations, actually the 190 actually comes from the associates, which is Bharti, Telcom, Advanced Info, and so forth. Next slide. So for Starhub, so we see stars. It's not see good stars. Basically, you know, see stars means you get knocked out. So fourth quarter is going to be quite a bad quarter for them. Next slide. So for the review, the earnings was within expectations. You will notice that the revenue was very strong, 14%, but it's mainly because of broadband. You notice the broadband line revenue up 28%. That's because there was a My Republic acquisition there. So in terms of the positives, is again similar to Singtel. The mobile revenue has recovered. So it's always very rare you get a volume go up and also price. So this is one of the things that benefited them. Usually either one goes up, but not both. So the mobile revenue was up almost 9%. So that's to show you how matured the mobile business is. A 9% growth is the fastest you've seen since 2007. Since then, mobile revenues is probably 1%, 2%, 3% at most. So the rebound again, similar to Singtel, is up because of roaming, and they also got a growth because they have this new no SIM plan called Giga. The negative is, as highlighted since the beginning of this year is going to be a transition year for them. So you will notice on the table on the left, there's a surge in operating expenses by 20%. So they really highlighted and they kind of mentioned to investors that this year is going to be invested. They're going to spend a lot of expenses. One of it is actually EPL content. So you notice that Starhub has taken over is the one that is providing English Premier League content. The other thing that they're doing is also IT investments. So they're spending a lot on IT. And all of this is under this transformation name that they call Dare Plus, which they're going to spend all this and eventually generate revenue. So far we jokingly say so far we've seen the Dare. That means they dare to spend a lot of money, but we haven't seen the plus. So we haven't seen where's the revenue coming from this transformation. There's going to be an investor day on 7 December, so hopefully they can share more details after spending all this money, right? So where is the revenue growth driver? So in terms of the outlook, there's a lot of moving things here, but they raised their guidance in revenue and they also lowered their guidance for CapEx. So these are the two positives. But the problem is that they didn't move margins, their margin. They didn't raise the margin guidance. So in a nutshell, fourth quarter, you're going to see we think the margin is going to drop to 14%. If you notice, the third quarter margins was about the service margins was about 20%. And for the years about 23. So what this means is that fourth quarter, you're going to see a big collapse in margins. So there's going to be even more spending in the fourth quarter. And to make matters worse, there's also going to be some write-offs coming up from their healthcare and some legacy, and they're going to write off a lot more IT systems. So this is going to be a kind of bad hit for them in the fourth quarter. But of course, strangely, even though all this negative news, why do we still have a maintain accumulate? It's mainly purely for valuations. So we always peg them to the industry, nearly 7 to 8 times EV EBITDA. So when we peg that, they are still trading at a $1.15 target price with a dividend of, I think, around their dividend guidance is 5 cents, at least 5 cents. So right now the share price, so you're getting about 4% kind of dividend yield. So we only have a accumulate mainly because of valuation reasons, but do expect some weak numbers coming out in the fourth quarter. The next slide. Okay, next slide. So in terms of so for macro, there wasn't much from Singapore, but so for tourist arrivals coming into Singapore, it was still a very, very strong number, about 800,000. If you want to do year on year, it's probably like 33 times year on year. Yeah, not 33%, 33 times. So we are still 50% below pandemic. So there's still going to be a lot of room to grow in terms of tourist arrivals. So the next, at least the next 6-12 months, still going to see a lot of tourists coming back into the country. The other good number was the real traffic number. So this is, of course, good for comfort, is that October real numbers, passenger real, that means the number of people traveling in October was 1 million. So though this real is actually confined to SBS, it's not SMRT, it's just purely SBS real numbers. So you should expect a strong rebound in fourth quarter. And surprisingly, it is only like 13% of pre-pandemic. So the rebound in real has been exceptionally strong. So the US numbers, I think we know for the CPI, the one that carried the market. So in terms of, to put that into context, it's still high. I think 7.75 is still high, but it is the fourth consecutive month of decline year on year, and also the other one is the core CPI. It's a bit more technical here, but it's only moved month on month, so it's one of the weakest in 13 months. So in terms of our tactical views, I think this rally has leaks. So what we saw last week is the repricing of all assets. Of course, maybe cryptocurrency, but bonds, equities, just being repriced as a gap up in valuations because there is a more predictable Fed now. I think that's what since inflation looks to have tamed, and although we don't think inflation will come off very sharply, but I think more important is the direction. The other more important news that helped the markets also, China face reopening, so they're starting to relax measures, and also the big property support coming out. So there's about 16 measures announced. I think came out in the Bloomberg and Business Times article. Yeah, we're not China experts, but just to give you some flavor, basically what it means is that the China authorities telling all the banks to extend loans, because in the past, Chinese banks were very hesitant to lend to China because you're not allowed to actually lend on property, but now that's actually done like a 360 reversal. So now the government said, you please support the property sector. So I think that's one of the news. Yeah. Okay. The things to watch out for, I think a lot more is probably some of the Chinese tech names. Again, no, we don't cover, but just for your info, there's Tencent, Alibaba, JD.com coming up. And these are some of the events that we are organizing. Next slide. So just to give you some graphical illustration, so this is the CPI. Sorry, on the left is the CPI inflation in the US. Of course, we just have to go into a bit more details because since this is going to be, everyone's going to be watching this as a lead to where interest is going to be. So if you look at the red line, so this is the CPI. You read the newspaper, but you notice most of the components are coming down. Goods is coming down. The green line, sorry if it's hard to see. The gray line is energy, obviously. Services, so only thing that's still holding is services, which is blue line, mainly because of shelter. So services excluding shelter, I guess due to some technical thing on the way they calculate medical insurance. But anyway, the directionally, that is the key thing for us is everything is trending down. So that's probably the positive thing. But don't expect CPI to drop all the way down back to the usual 2-3%, because if you look at the table on the right, in the 1970s and the 80s, it took almost 2 years to 3.5 years for it to trough. So what we think is that interest rates, we think will still high. We still think the Fed is going to move rates to, they like to call it terminal. That means the level where they will pause longer term rates. We still think interest rates will move from the current 3.75 to 5%, or maybe not now, maybe can get it down to 4.75. So we still think rates are still going to be high, because I think Powers already mentioned that they don't want to make the mistake of pausing. Then like what happened in the 1970s where inflation rebounded. But no, don't go. We're not going to go so detail here. But so we still think interest rates are going to climb to at least around close, or if not 5%, close to 5%. Next slide. Okay, so this is a last slide. So this is the golden energy gear takeover offer, because we got a lot of emails, some especially in the community chat. So let me just give you a nutshell. So there's two parts to the offer. So firstly, golden energy or gear, the one that's listed in Singapore, said that they're going to distribute. First part of the restructuring, they're going to distribute the GEM shares. So Gear actually owns, I think, 60+% in GEM. So GEM is the listed company in Indonesia. So they're going to distribute. Then after distributing, they're going to give you an offer of 16 cents, which is not, it's 0.16, sorry, not 6, yeah, sorry, 16 cents, sorry. So the offer, so in conclusion, there's two offers for investors. There is, you either take the Indonesian GEM shares, which I'm not sure how many Singapore investors want to take it, but you will take 1.396 GEMs, Indonesian GEM shares, and you will get Singapore cent 16. So if you take the current share price of GEM shares now at rupiah 6875 plus exchange rate, you get an offer of $1. But if you take the all cash shares, so this is a bit of a tricky part here. You will still get the GEM distribution because this is separate from the offer of 16 cents. But instead of but the major shareholder will buy back your GEM shares at rupiah 5,005. Okay, so this is the one that a bit more confusing for people. So in the end, based on the exchange rate, you will get 68 cents for the GEM shares, the Indonesian GEM shares. and you get you expected the 16-cent shares, and your offer will be 84. So I mean, the questions you always get is why is it below? I guess the two risks for this deal is whether the deal can pass through, because the major shareholder that owns, I think, 77% cannot vote. So it's left to the minority to vote, and of course that causes uncertainty. Otherwise, I think arbitrageurs will come in and just arbitrage it. So there's uncertainty, the deal will go through, and of course there's also the volatility in exchange rate, because technically he's going to give you at 5,500 rupiah, and then of course the Indonesian rate, I mean, whatever the rupiah rate. So that's why it may not trade there, because the risk the deal don't go through and the rupiah exchange rate. Okay, I think, yeah, thanks everyone. I know not everybody is bothered to know what's happening here, but in case anyone was going to ask. So thanks. I think we'll move on to Q&A.
Yeah, thanks, Paul. I think I'll
We
take,
go to the community slide. Yeah.
Oh, yes. Okay, yeah. So this is our community side. Okay, so I'll just take a few of the questions first. The first one being for CapitaLand, CLI. How much is their revenue coming from China or exposure to China markets in percentage terms reference to their overall? So they don't give the breakdown for their revenue, but if you look, I think they gave it for full year 21 in their annual report. So that was 19%. So China contributed 19%. But if you see their the most recent results, they gave the breakdown of the China market and how much it is in percentage terms to their real estate AUM and as well as the FUM. So real estate AUM is 35% of total and FUM is about 31%. They also gave the breakdown of the lodging management. So that comes to about, China makes up about 28%. Okay, so I hope that answers your question. I have a few questions regarding the banking as well and the SGX. So I'll take the SGX one first. So this question asks, what is SDAV and DDAV? So SDAV stands for Securities Daily Average Volume, and DDAV is the Derivatives Daily Average Volume. So okay, let me go back to my chart, and I think I can explain it better there. Yeah, this one. Okay, so why is the DDAV important? So we also look at it in relation to the VIX. So what is the VIX? The VIX is the number derived from the prices of the options premium in the S&P 500 index. And this represents a good indicator of the expectation of the market volatility. So if we look at this chart here, right here, you can see that the DDAV and the VIX, they follow quite closely. So when there was a spike in the VIX, the red line, we can see that the DDAV will also follow suit. So this is assuming that there will be volatility in the market. We can expect that the SGX would benefit from the increase in their derivatives volume, which is their DDAV. So with the VIX going up, we should expect that the DDAV will go up as well. Okay, and there's one more question regarding the banks. I think it's just a very broad question asking me to explain what are the terms that I'm talking about. So I'll go back to my banking slide here. Okay, so I think I'll just go through this table right here. So net interest margin, that's the net, how much margin they earn from their net interest. This net interest income. So I think they're asking what is the CET1 ratio. That is the common equity tier 1 ratio. That shows their capital. So the higher this means that they have more capital. So if you look higher, doesn't mean it's better per se. It will be better, like, so OCBC, sorry, is at 14.4%. So we can expect that they will need to spend their capital to bring it down to their optimum operating range of 12.5 to 13.5%. Hence, we could expect either higher dividends or they might look at acquisitions. So both DBS and UOB, they have lowered their CET1 ratio by actually acquiring the Citigroup assets. Okay, next one would be the NPL ratio. So this NPL ratio here is the non-performing loans ratio. So it's the ratio of the non-performing loans to their total loans. So the lower the number is better, and we can see that in this quarter, the third quarter, all the banks improved their NPL ratio. NPA coverage is the non-performing assets coverage. So how much do they have coverage for their non-performing assets? So this number, again, higher would be better. So we can see that it's all above, close to or above 100%. So that's quite good for the banks. I think the rest, cost to income ratio, I don't have it here, but this is what is their expenses to their income. So the banks have all moderated it at around, I think, about 30 to 40%. So yeah, there's nothing much for me to say regarding that. They also expect expenses to go up as the cost of retaining people as well as hiring new people has increased. A general provision, so this is how much is set aside for their expected, I would say, the non-performing loans. Provisioning cycle. Okay, I think the rest are quite self-explanatory, I think. Let me see if I have any other questions. Okay, I think that's all for me.
Yeah.
I'll hand
Okay.
it over to the rest.
Yeah. Let me go because I probably have to. Sorry, I have to rush up for a meeting later. But let me just try to answer as much as I can. Sorry to have to leave earlier. What is your take on Wilmar fundamentally and technically? So, Zane will help you out on the technical part. For Wilmar, we still think the outlook is still positive. I think so. What we look for Wilmar is hog prices, swine, basically pork prices. So that's still trending up, and also their ability to pass on the cooking oil price. So that is still trending up. So and also they benefit because the palm oil prices. So so far in general, most of these fundamentals are still trending positively. So we don't see any major deterioration. Maybe next time we will do a slide and show you some of the rough indicators we use just to monitor how are they doing. Of course, it's not the absolute, but I think fourth quarter will still be strong. But I don't think they can replicate what they did on third quarter. I mean, that's what they actually did mention that. So I think fundamentally, I think still healthy for Wilmar. Because what most important is the hog prices recover, so then their crush margins can improve in China. Yeah. Sorry, I hope it helps you. Okay. Let me hi Paul, what's the expected impact of SGX listed equities arising from the impending GST hike? I think it's with 8% with effect. I think the impact will be very minimal. Because 1%, those that will impact will be those that have domestic consumption here. So food and beverage, I'm not sure whether 1% is going to hold back everyone going to restaurants and so forth. The one that I initially was worried about was property developers, but it may not impact them that much because construction cost, let's say now is $400 per square feet, right? So even if it's a 1%, you're talking about $4 per square feet, which I think they just have to raise price, they will offset it. So apart from so that was my initial worry, because developers can't pass on. There's no GST when we buy properties. So they virtually have to absorb, but construction cost so small, I don't think it's going to have much impact on them. It's probably like additional $4 per square feet. They just charges more, I guess. Yeah. So I don't think the impact will be huge. Of course, there could be impact on Sheng Siong, but the government is giving up vouchers, so they may actually benefit from that. So there could be some temporary buying, a little bit of buying ahead, which could affect maybe, which will make maybe Sheng Siong's fourth quarter results better, but the first quarter a bit slightly damp, but we don't think it will be that material. So the impact isn't significant for us, I think. Yeah. Because only 1 percentage point. Hi Paul and team, any views on Golden Energy delisting and why it's not trading to all cash? And it's one other option, the Indus shares and cash. Yeah. So I think we already gave you that slide, so hopefully that helps. So we actually had to talk to them. It was also confusing for us, frankly. So we actually had to talk to them to try and understand the technicalities of the whole structure. Yeah. Subsequent to any crypto crash or bankruptcy January, should we expect the equities market to go into a tailspin? We don't think so. Because this is not like Lehman, because most of these assets, I think the fallout you probably see would be more on the cryptocurrency, because if whoever's holding a lot of crypto, they need liquidity, they might have to sell the rest. Yeah. So, but we don't think it will flow into the current markets here. Indirectly, it will flow to those US listed stocks like Coinbase and so forth. They might get a bit of impact if people not interested in crypto anymore, or those who are doing crypto mining, which I think Jonathan can help you on that. But in terms of the equities in general, no, we don't think there is a systemic impact from the rest, because there's no forced selling. I think those people who buy crypto probably aren't really big equities. Yeah, they don't get that. So you always worry is who's going to get the margin call. So the margin call is going to be maybe those who had some crypto in FTX, then now he has to sell his crypto in Binance or whatever because he got a margin call in FTX or music, because he would basically can't even take anything out. So we don't think that so-called margin call is going to affect the assets outside crypto. Okay, let me can you comment on Starhub's dividend consistency and any growth areas? So for Starhub, the dividend is consistent. So even though in this lack of better word, troubled time, where they have to upfront invest in a lot of things, they still maintain a 5 cents dividend. So the dividend of 5 cents is like engraved in stone, because they know if they lower that dividend, the market's going to, not that the share price has already fallen, but it won't fall even more. So their guidance is at least a 5 cent dividend. So they will pay 5 cents or more for dividends. So that is their guidance. So we think dividend is consistent for them. So dividends are not particularly worried. Just that in the very near term, there won't be much growth. Their growth areas I think they're trying to leverage on content. To take the EPL content, my own understanding is to take the EPL content and try to use it to penetrate pay TV customers and to try and get on more subscribers with that content. Yeah. Because they haven't really shared much on, after all this restructuring, where is going to be the growth area. So they've been a bit silent on that. So the only one that we could get some inference was from using EPL content, since you paid so much for it, right? So you have to do something different. Otherwise, it's just another Singtel selling EPL content. So that's one of the initiatives they're doing. But mentally, I don't really see much traction on that. What's the latest update on Tasin? Okay, Tasin is going to do a briefing on Wednesday. So once the briefing is done, we will probably do a Phillip on the ground and try to brief everyone. Until the briefing, really got not much updates for everyone here. Yeah. So the following Monday, we will do one and try to update everyone. Uni Asia share price is down and stagnant compared to other shipping stocks. What went wrong? Okay, I think for Singapore shipping, if you're referring to Singapore shipping, Yang Zhejiang, those are a bit different because Yang Zhejiang is a shipbuilder. Marco Polo Marine is also shipbuilding, and Marco Polo is also offshore marine, so they're more oil and gas related. Because theirs are vessels catering to oil and gas and also renewables. Uni Asia is down because if you look at the Baltic Dry Index for handy size, which is where they're in, it is for the third quarter, I think it's down. I did a rough check just now, it's down about 45%. But this index is very volatile. So their third quarter, so this index is a reflection of the freight rates that they will enjoy. So you could say that the freight rates is down 45% in the third quarter, because that's why the handy size. So I think that's what is causing investors to get worried. Yeah. Any thoughts on ComfortDelGro? Yeah, we still no change our view. We still like ComfortDelGro. The results will be coming out end of this year and end of today. So we will have a briefing and then we will share with everyone. The results coming out after the market close today. But we still like because we always like the cash flows. Like we mentioned before, compared to SIA, where the economics of the business wasn't great, and also because of the amount of cash they had the amount of cash they were burning, and they had to get external funding. The opposite was for ComfortDelGro. So they actually generated a lot of cash, almost 900 million during the whole pandemic. So yeah, so that's why we still like it. It was our more value-driven way to buy the recovery. So we expect strong results. I think you already seen some of it in SBS Transit results coming out, but you have to strip out some of the recovery benefit, some of the government grants, then you will see the actual recovery in SBS Transit. Yeah, so we already got a flavor of the recovery from the release of SBS Transit results. News of multiple data breach in Australia. How would this impact telcos and insurance costs? Yeah. I mean, you're right. They're probably going to be higher premium, but how it impact? I think, like we mentioned earlier, is the biggest worry now is whether there's going to be a big class action. So that one is a big unknown for us. I'm not sure, because once you go into class action, it's dependent on the court and also dependent. The number could be I'm not sure whether can say obscene, but the number is actually can be quite huge. It's a bit open-ended in how much. So we don't have much clarity, frankly speaking. I mean, some estimates 200 million or so, but again, these are all guesswork. So we don't have any guesstimate of to how much could be the impact for them. Yeah, sorry, couldn't. Not much details we can give you. Let me try to answer this last few. Paul, any comments on APAC Realty versus PropNex? Look like APAC Realty is losing market share, but its valuation is more attractive. Yeah. Okay. So for us, no, for us maybe why we cover PropNex and we didn't cover APAC. I mean, both are good companies, but we want to buy the leader. I think when you're playing, I think all of you probably know this better than me. When you're buying the stock market, you just want to buy the leader. And the leader usually trades at a premium. You want to buy the biggest, you want to buy the most liquid, and then you hardly trade the rest. So that's why we only focus on PropNex. And judging on the recent financial performance, yeah, I mean, it does look like they did capture market share. Okay. Okay, let me try to answer it for you. Starhub, Paul, its margin and profit has been declining for quarters. It's concerning that their costs do not look like under control. What confidence do you have that they claim that they are increasing costs in purpose and justifiable? Yeah, I think it's a very fair point. I think it is a very fair point. I think, but do note that before they went into this whole restructuring the last 3 quarters, they did cut down a lot of costs. I don't have the details here, but if you look at when the new management came in, probably 2020, the earlier transformation, sorry, I should know this, but the last 3 to 4 years, they actually did cut out a lot of costs. So they did do well in the previous transformation, which they call it. The previous transformation was called DARE, so this one is called DARE Plus. Anyway, so they actually did cut a lot of costs, and you could see it on the line items. Just that the earnings didn't recover then because of the roaming. So one of the reasons why we have confidence that the management team has a track record in actually cutting costs after that. Yeah, in the previous DARE transformation, which was another 5-year period, which I slip my mind, which is I think it's up to 2020, probably 2018 to 2021. Yeah, around there. Yeah. Anything new on HRNet with reopening and yeah. There's anything new coming? There wasn't no announcement, so nothing to update. What about Singtel dividend business revenue compared to Giant and FairPrice? So if you approach yeah, so Singtel dividend is still held. I think they're paying like a 3% dividend yield. So in terms of the business revenue, I think if you know any Giant or FairPrice management, I think the one thing you can ask them is that they always envy Singtel, I guess, is Singtel's fresh food business. So I think if you know them well enough, they will always tell you that the ability for Singtel to manage the fresh business is something that guys like Giant have been unable to replicate. I think you can even walk into a Giant shop, Giant, you see their fresh compared to Singtel's fresh. I think you can see the difference. The one is more you can see the quality, the variety of the fresh food. I'm talking about feed and meat and seafood compared to if you walk to a Giant shop. So I think that's the difference. I think only FairPrice probably has something comparable, but the main difference has been Singtel's ability to execute well in fresh food. Yeah. So I think that's the main difference in the business revenue. And of course, Singtel shops are all HDB, and HDB, the rentals are more affordable. You never see a Singtel, okay, not that I know of, or maybe there is of course some, but most of their stores are not in malls, and you know how much malls are going to charge. So whereas FairPrice are more in malls. So I think that's the difference in the revenue models. Because there are some Singtels in malls. Hi Paul, for Yangzhejiang Financial, what's your view since they reached max cap shares? Yeah, I think it's going to be challenging for Yangzhejiang Financials. I think earnings is going to decline for the next 2 years. The reason why we say that is because they are transitioning all the profit from China and moving up to Singapore. I mean, apart from taking the money, they are probably slowing down the money lending business, like a better word, in China, and bringing it to Singapore to do private equity. And this takes time. I know you start a private equity fund, you're not going to generate any revenue or any, they call it carry, right? Any profit until 2 years time. So my guess is the next 2 years, Yangzhejiang Financial earnings just going to come down. Yeah, because they're in this transformation. They're shifting all this money lending business to Singapore, and Singapore, you put all this money day one, you're not going to get any revenue. Yeah. Best World, yeah, sorry, I'm not sure. I think you have to ask the rest. Have been declining. Okay. Okay, I think I'm done with most of it. Okay, I have to go. So I think the rest can help answer. Yeah. Thanks everyone. Yeah, sorry I have to go off earlier. And thanks for all your questions. Yeah. The rest can carry on. Zain, maybe you want to start.
Okay, hi everyone. I'll just go to the charts. Okay, so the first one I see is SATS. Okay. Okay, is the upward momentum for SATS SIA getting sustainable? Okay, for SATS, looks there's a chance that it has based out for now. So previously at the 252 bottom back in pandemic lows, we retested it recently over here once, and then over here last week Thursday we also retested it again, and then we found support on both occasions. So for now, I would say there's a chance this 250 area is a temporary bottom if it doesn't breach again. For the first resistance, you can see is the swing high generator over here near the 280, around the 280 area over here. And then if we go above it, the next resistance to look out for, it will be this swing low that we broke down off. That's around 294, and followed by the next one is around 315. So for now, if let's say we manage to do a W-shaped bottom over here, which is like over this, and then we break above this 284 neckline, then there's a chance that SATS can do a bounce upwards. And for the next one, SIA. So SIA is quite interesting right now. So because it's currently, when you look at the long-term chart, it's currently in this very big consolidation triangle over here that spans all the way back from late 2021. So for now, the resistance will be near around 550 over here to around 560 level over here. This is quite a huge resistance. But if you do manage to break out of this resistance area, right, I think there's a chance for continued upside. For the support wise, it's likely to be recently it's around this 520 over here and 5 to around 530 zone over here. So as long as this support holds, and we continue to make higher lows into this resistance, there's a chance that there might be some breakout to come, which might bring the stock to maybe near the $6 or $6.20 level, which was another resistance level last time. Okay, then Genting also looking good, still in this uptrend channel. Then he also broke out of this triangle consolidation recently. So for now, I think that it might face some resistance at this area, which is 845 to 850 zone. If this uptrend channel holds, then the immediate support wise is around this previous strong resistance over here, which is around 805 to 815 will be the very strong support now. But in the case that, let's say, if we break above this uptrend channel over here, right, the next resistance you might look out for is 87, around the 880 is level over here, which is a swing high, and then a previous support area over here that we broke down off. So that's for Genting. And the next one is Yangzijiang. So Yangzijiang is a very strong uptrend. Today we tested the key trend line resistance over here. So it spans all the way back from February this year. So we see once, twice, thrice, 4 times, and then this is the 5th time we are touching it. So today the high of 142 If you can break above this level, there might be a resistance to watch out for. For the immediate support wise, it will likely be this 130 level that we broke out of over here, which is also a psychological level. Then the next one lower than that is probably 124 to 127 over here. So that's for Yang Ziyang, something to take note of, this possible resistance at this key trend line over here. And for DBS, EBS, we broke out of this uptrend channel over here, but we are still resisted by this key trend line over here. So for now, we might see some resistance at the combination of this swing high around the 34.70, around 35.20 level over here. Then the next resistance, if we manage to break out of here, then the next resistance will be the year high over here around 35.90. As for immediate support, if we do back test this channel that we break out of, the support will be around 34.20. But if we go lower than that, we might see 33.40 over to 33.70 over here. So that's DBS. For OCBC, looks like it's approaching to test the key resistance over here around the 1240 level. So it will be if it does test, it will be the third time that we are testing it. So let's see whether we manage to break out. If we manage to break out, the next level will be this 1260 level swing support that we broke down previously, and then the 1290 high of this year. For the support wise, currently it will be at this swing low generated over here around the $11.90 to $12 area. And the last one will be the strongest local bank stock, which is OUB now. So after the results, it just continued to keep flying upwards. It also broke this resistance that I mentioned last week at 28.90 to the 29.30 area over here. So the next resistance we are currently at it over here, around the 29.90 level, a swing high previously. But if we clear this level, the next one we might see $30.30, which is the previous swing low support over here. Then even higher we might see is around 31.20, which is another swing high over here. Then from the Fibonacci retracement perspective, from the highs this year to the lows back in July over here, currently we just passed the 61.8% level at around 29.40, 29.50. So if we clear this level convincingly, the next one we should be able to see at least $30.30 to $30.50, which is the 78.6% level, this zone over here. So that's for UOB. Okay, for the technical view on Wilmar, let's take a look. So previously I mentioned Wilmar is bearish because there's possible head and shoulders formation over here. And then we actually broke down this crucial purple color neckline zone over here. But we managed to recover back up over here. And then last week, we also broke this around the 397 resistance over here, which tested 3 times, then we broke out over here. So currently we are at the resistance level of around the $4.08 to $4.10 area, which is a swing high over here. So let's see whether we can continue to break upwards. In that case, the next resistance will be near around 420 to 425, these 2 swing highs over here. Okay, then from the Fibonacci perspective, from the highs to the lows of this year, currently we are at 50% bounce. So if this we manage to clear this 410 level, it's likely that we can see 420s, which is 61.8% level, which I think will be quite a strong resistance over here, given that this is the key level to watch out for, as well as we tested 2 times over here during the downtrend over here. So then prime US REIT. And for prime, recently we retraced to this green color support zone and we tested the swing low around 46 cents. Then there was a support over here that generated the horizontal support around 460. Then we managed to clear this swing high resistance over here around the 50-cent mark. So it's likely we see some upside continue to test probably this next swing high around 55 cents to 56 cents over here. And this will also match the retracement level of 61.8% from the peak to the trough over here of the COVID lows. So that's the immediate resistance for prime to watch out for. As for Manulife, okay, so Manulife recently looks like we are at the swing high resistance of 39 cents over here. We could be doing ascending triangle formation over here. So if we manage to break out, then this could be a short-term reversal to possibly test this swing high over here around 42 cents to 43 cents area. And it will be a retest of this previous channel support over here that could become a resistance over here now. And also one thing is that the 45 cents area was a previous support back then in the COVID lows. So that could become a resistance over here now. So this red color zone is a resistance to take note of for Manulife. Okay, what's the outlook for REITs like CICT, FCT, and Mapletree PanAsia? Okay, so for the technical outlook for CICT, looks like recently it did a very strong rebound. I still in trading in this downtrend channel for now. So one thing to note that we could possibly be at the resistance. We are near the resistance level here, 208. And then when we use the Fibonacci retracement from the high of 230 to the low of 174, we are at the 208, 209 levels, also 61.8% level. So that's there's a resistance that you might want to take note of. But if we continue to move higher, the next breakout of this downtrend channel over here, right? The next resistance could be around 213, which is this bunch of swing highs over here. So that's another level to take note of. Then Mapletree PanAsia recently also broke out. It recently broke out of this downtrend channel over here, where we did a double bottom at 153. So currently, we are at the previous this red color zone, which is a previous support level now turned resistance over here. Also from measured using the Fibonacci of this swing high 193 to the low of 152, standing at 50% level over here. So that's could be some resistance over here. Then the next one will be at 177, which is a 61.8% level, and the combination of a swing high resistance back over here. So I think for now the upside could be limited to this area over here, given the forceful way the price has been moving upwards. So that's for Mapletree PanAsia, and the last one will be Fraser Centerpoint. So Fraser Centerpoint also similarly a double bottom formation at around 190. We are currently approaching the swing high resistance of 205 over here currently, which is a strong level given that it was a support over here that broke down off. I think Fraser Centerpoint could have a little bit more room to go further, which could test this downtrend channel resistance over here. That could be a target of around $2.10 to about $2.14 area. The 50% 50% to 61.8% retracement area, 210 to 215 this level. So if you manage to break out of 205, 206 over here. So that's for Fraser Centerpoint. Hong Kong Tech. Okay. Hong Kong Tech actually quite interesting recently because when we strip out, let's say when we strip out the charts, there was this huge volume day back in 24th October over here, which is the highest volume ever recorded for the HS Tech and see over here. And coupled with the fierce sell down recently over here, there could be signal that this could be a capitulation volume over here, which could be a signal that a short-term bottom is in for the Hang Seng Tech, as the huge volume suggests that many players have actually thrown in a towel, and the selling pressure could be abated for now. And then recently also there's this downtrend resistance line that we broke out of just today. So there's also another bullish sign for HS Tech. Okay, when looking at the Fibonacci levels, currently we are sitting near the 38.2% level, around $3.62. So if this upward momentum continues, we could see 390 possibly at 50% level, and the next key one will be around 418, 419 at the 61.8% level. And for now, if this proves to be a false breakout, then this 367, this swing high over here, will probably act as a resistance over here. And then this previous swing low at around 380 will also be a resistance to take note of. So let's continue to wait for more signs on whether this breakout is a real one or not. Okay, CSE Global. CSE Global, actually there was a gap down over here and currently doing a descending triangle bearish formation. So currently the key support is at 34 cents. And I would say the key resistance for now is probably around 35.5 cents to 36.5 cents area. But the chart looks like it's still bearish, given that we have a descending triangle formation, and also we could possibly test this long-term support line that's holding CSE Global. So weekly chart wise, that would bring us down to near the 30 cents area if you do a breakdown over here. And, in view of time, I'll just go through the two more, which is ComfortDelGro and Rex. So ComfortDelGro, yeah, it's a bit confusing. So we're in this downtrend channel over here. So recently we also broke back up of this trend line over here. So over here, we are currently at the 61.8% retracement level from the high of 146 to the low of 123. We're at 137. So this could be some resistance over here if this is a retest of this trend line over here. But if we move back up, continue to have strength, it's likely that we can have a chance to test around 145, which is this key trend line down channel resistance area over here. So that's for ComfortDelGro. Okay, and then next one, Rex. So Rex broke out of this key downtrend resistance line over here. Then currently, I think we are currently doing a consolidation over here in this triangle formation. So for now, immediate resistance likely to be at 25.5 cents to about 26.5 cents area over here. And 25.5 cents is also a key horizontal level for REX. For the support wise, probably we can take these swing lows over here, which around 22 cents to 23.5 cents area. So let's see whether we manage to do a breakout of this triangle a few more days or weeks to come. Then we can see the next direction, whether it's up or down for REX. Okay. So that's all from me. I'll pass on my time to my colleagues to have any for any questions they want to answer before we end the session.
Thank you, Zen. Let me take on a few questions. So first of all, PayPal recently sought to impose $2,500 fine or penalty to any user that they deem spreads misinformation. That triggered an exodus of user comments. So basically in October, PayPal updated its user policy wherein they stated that they would impose a $2,500 fine on any spread of misinformation. However, the company said that it's by mistake and they removed that particular clause, and it has not been reinstated again back into that user policy. So and with respect to the user growth, the company said that in the fourth quarter, the company expects a user growth of almost 3 million to 4 million net active users, which is in comparison to the third quarter were about 2.9 million. So the growth, it could mainly come from strategic partnerships from Amazon. Yeah. And with respect to the second question, how would Microsoft price correct in case that it ain't acquire acquisition visa due to regulators ruling? If the deal breaks, if the deal fails in the near term, it could have an impact. It could, the Microsoft stock, it could be under pressure. If the market, it feels that it is giving up too much to save the deal. The Call of Duty, it has a strong position in the gaming market, so Microsoft might lose out on that. However, any fall might be considered as an opportunity, mainly because of Microsoft's earnings visibility, as most the demand for its products mainly comes from corporates and not a one-time from a consumer basis. So also with respect to digital transformation trends, it's Azure cloud demand would be better, and there could be a surge in its cloud computing services. So I hope that answers the question. I would pass on to the rest of my colleagues. Thank you.
Yeah, let me just take the rest of the questions here as well. Clear the rest of the questions in the queue. I think there's a question on SATS. Do you see an continued upward momentum for SATS? Yeah, so for SATS, SIA and Genting Singapore they're all benefiting from different factors, but mainly because of the reopening in China. So because of the reopening in China, the news of that, they have lifted them up. For SATS, we are a little bit more cautious. We think that the rights issue will remain an overhang, but overall the message has been a positive one for the company for SATS. So I think we could see a re-rating after the conclusion of the rights issue. Yeah, I think that's all for me. I'll just hand back to the rest of my team.
I think the rest of the questions are mainly the REITs questions for Darren, and some for Paul as well. I'm not sure if he answered those. Anyway, no worries. I flashed up our Poems 3.0 app. So you can join our community group if you have any questions, and you can scan the QR code to join, and we will try to reply as fast as possible. Darren's on leave currently, so he's not able to attend the webinar today. But do join our group, and post your question there, and we will try our best to reply there if we can't reply all the questions here today. So I think that's all we have for today. Thanks so much for joining us, and have a good week, and we hope to see you next week for next week's webinar. Okay, thanks everyone.